Today we're going to be talking about everyone's favorite topic, inflation. Inflation has been picking up a lot lately. What kind of assets should you own in a high inflationary environment? And more specifically, how do stocks tend to do when inflation picks up? So in this video, we're going to talk about how inflation impacts the stock market and which financial assets you should own to protect yourself. I'll also show you a simple way that you can predict what inflation is going to be over the next 5 and 10 years. We'll look at how stocks, bonds, gold, and commodities perform from 1988 through 2020. We'll look at 4 different inflationary environments, high and low, as well as both falling and rising. And then at the end of the video, I'll share the best asset to protect against inflation, looking at data from 1926 to the end of 2019. First of all, what is inflation? This picture sums it up pretty well. In fall of 2020, $1,000 would buy you this much lumber. In May of 2021, $1,000 would buy you about 15 boards, 15 2x4s. So inflation is generally, not this extreme, but generally it's the increase in the cost of goods and services over time. So one of the objectives of any investment portfolio is to keep up with inflation and increase your wealth above and beyond that. So if you increase your portfolio by 5% and inflation is 5%, you have not actually increased your purchasing power, which is one of the main objectives. Inflation started getting a lot of headlines a couple of months ago when the April and May 2021 inflation readings came in at over 4% and the May 2021 reading came in at 5%. That is quite a bit higher than we've seen really at any point in the last decade. The 2010 to 2020 period saw inflation average 1.7%. So to see a number like 5% is really pretty surprising for a lot of people. But why is inflation causing so much angst amongst investors? Why is rising inflation bad for financial assets, including stocks? The first reason is because rising inflation increases input costs. So let's say we have this fine group of young people selling lemonade. Let's say they sell $100,000 worth of lemonade and their expenses are $90,000, leaving them with a $10,000 profit. Well, if inflation were to somehow double the cost of lemons and their employees and water and wood to make their stand, that would mean that their $100,000 in sales are no longer adequate to keep up with $180,000 in costs. So to keep their $10,000 profit, they're going to have to increase prices so that they make $190,000 in revenues and expenses are only $180,000, leaving them with the same $10,000 in profit. The problem is raising prices of their lemonade is likely to reduce the sales. So the unit sales of a cup of lemonade are going to decline if they double the price. So inflation really is not a good situation. Typically, the best case scenario is that a company can maintain its current profitability. It's very rare for a business to be able to grow its profits in an inflationary environment. The other problem with rising inflation is that it generally causes interest rates to increase. So here we see the dark red line is inflation. The orange line is the 10-year U.S. Treasury yield. You can see that the relationship between the two is, while not necessarily perfect, it does generally trend in the same direction. So as inflation has been decreasing really since the 1980s, the 10-year U.S. Treasury has also been decreasing. The Fed gets a lot of the blame for why interest rates are so low, but really the long-term Treasury yield is set by more economic growth and inflation. The Fed really only influences short-term rates. They can try to influence long-term rates in other ways, but inflation is a big driver of long-term interest rates. And when interest rates go up, that generally pulls stock prices down. So here we have a chart from Fidelity showing the average price to earnings ratio for the S&P 500 in different inflation environments. So in the last decade, we've been between 0% and 2% inflation, and that has historically led to the highest price to earnings ratio for stocks, averaging 18.1%. Or not percent, sorry, 18.1 times earnings. If inflation is indeed 5%, like we just saw in the May 2021 reading, that means that the average price to earnings ratio for the S&P 500 will drop from 18.1, or today it's really at over 20, depending on what earnings number you're looking at. That will drop to an average of around 15 times earnings. And if inflation increases to beyond 10%, now we're looking at an average price to earnings ratio for stocks at 8 to 9 times earnings, which would be more than a 50% decline from where it's at today. So clearly, if inflation were to really get out of hand, that would be very bad for the stock market. It would also be very bad for bonds. As rates go up, bond prices go down, so bonds would not do well in this inflationary environment. Inflation really is bad for most types of assets. To illustrate why these rising rates cause price to earnings ratios to decline, let's go back to our friends at the lemonade stand. Let's say they make $10,000 per year and you are interested in buying this stand. How much are you going to pay for it? Let's say that interest rates are 0%, and in order to make an investment in this lemonade stand, you want to earn a rate of return of 10%. So what price would you pay to make a 10% return? We could simply take the earnings divided by whatever your required rate of return was, and that would tell us you would pay $100,000 for the stand. That would be a price to earnings ratio of 100,000 divided by 10 equals 10. So you would pay 10 times earnings for this lemonade stand if you wanted to make a 10% return. Now let's say that interest rates on the risk-free interest rates would go up to 10%. So now you are either going to make 10% in the lemonade stand, which involves a lot of risk, or you can just put it in your bank account and make a guaranteed 10%. Now you're no longer going to be happy paying $100,000 for the lemonade stand. You want to pay less. Why? Because you need more return to compensate you for the risk you're taking. So maybe in this case, you would demand making a 20% annual return. So now what would you pay for the lemonade stand? Well, we can take the earnings divided by your required return of 20, and that would mean you want to pay $50,000 instead of $100,000. That would get you a 20% annual return if the stand continues to make the same $10,000 a year, or 50 divided by 10 equals a price to earnings ratio of 5. So as interest rates go up, the price divided by earnings typically will fall, and that holds for all types of stocks. So should you panic about the price to earnings ratio collapsing for the market? Not yet. The first reason why you probably shouldn't worry too much about inflation is that 2020 was a weird year. This is the Consumer Price Index. If we look here at the May 2021 data, we see that it did in fact increase 5% from May 2020 to May 2021. However, if you look a little closer, you will see that from March of 2020 to May of 2020, the prices actually declined. Why would the prices decline in May of 2020? Well, if you're watching this video in 10 years or something, we had a global pandemic and the entire economy was shut down in April, May, and much of the rest of the year. Prices didn't really go up, they went down a little bit. So now when we're comparing the May 2021 data to the May 2020 data, we should not be shocked that the rate of change was a little higher. The best way to probably look at this is to go back 2 years. If we do that, we can see that the rate of change for May of 2019 to May of 2021 really wasn't that substantial. This is a chart of the 2-year annualized inflation rates, and we can see that the actual number here compared to 2 years ago was a rate of 2.5%. That is still higher than any inflation rate we've seen over the last 10 years, but it's a lot more reasonable than 5% and probably a lot more realistic. So is inflation increasing? Yes, it definitely is. Hyperinflation kicking in? That does not appear to be the case based upon that data. The second reason why you probably shouldn't freak out is the bond market. So the bond market predicts what the inflation rate is going to be for the next 5 and 10 years. You can calculate that by looking at the 5-year US Treasury bond yield and subtracting out the 5-year inflation protected Treasury bond. So you take the nominal minus the tips, and that gives you what the implied rate of inflation is to make those two equal. If you look at that rate, it shows that the bond market is expecting inflation from 2021 to 2026 to be 2.5%. That is down a little bit from the high here around 2.7. It's a little higher than it has been, but nothing too crazy. The bond market has historically been very good at predicting both recessions and inflation. So I would take this number pretty seriously. This is probably about as good of a guess as anyone can have on what inflation will be. If we look out 10 years, we can see that the 10-year break-even rate for the 10-year US Treasury is actually 2.35. So if you compare the two time periods, you could say that 2.5% will be the inflation rate for the next 5 years. So that's what the market's predicting. The 5 years after that, if you back out of this 2.35 assumption, we can see that the 2.2% is what the market thinks will happen from 2026 to 2031. So the market thinks that inflation is going to increase a little bit to 2.5, but longer term is going to trend back down towards 2.2%. That is certainly not a hyperinflationary environment. So either the bond market is just horribly wrong, or the temporary inflation numbers are spiking for transitory reason. And the final reason is that even if inflation does pick up a little bit, stocks have usually been able to outperform it over time. Here is a chart from JP Morgan showing how stocks and different asset classes tend to do in different inflation environments. So anything below the line here is inflation below 2.5%. Anything above the line is inflation over 2.5%. And then on the left, we have periods of rising inflation, and on the right, we have periods of falling inflation. So if we look at all these different environments, we see that in most cases, stocks produce about the same rate of return. 11% when inflation was low and rising, 13% when inflation was high and rising, 15% when inflation was high and falling, and 12% when inflation was low and falling. All of those compare pretty favorably to other types of assets. We see that really the only environment where gold and commodities have outperformed stocks, at least since 1988, are whenever inflation is rising from low levels. Commodities have also done quite well whenever inflation was high and rising. So in a rising inflation environment, gold and commodities will do pretty well along with stocks, but stocks have tended to hold their own. If you go back to the 1970s, you can see that stocks struggled in that period, but they still produce positive rates of return. And if we look back even further, going to 1925, we can see that stocks are far and away the best asset for building wealth long-term above and beyond inflation. So this chart is showing a $1 investment in 1925 in gold, just a US dollar, treasury bills, long treasury bills or bonds, and large stocks. And you can see that stocks just absolutely blow away every other asset. They grew a $1 investment to $645 $5. That is adjusted for inflation. Compare that with the $1 growth in gold. $1 turned to $6.43. So stocks outperformed gold 100 to 1 going back to 1925. And the reason why I think that's the case, why we're seeing stocks do so much better than gold, is that stocks are a productive cash producing asset. You cannot go out and manufacture anything with a bar of gold. You can't grow crops on a bar of gold. Gold doesn't employ anybody. Gold doesn't make any new products or innovate anything. Gold literally does nothing except sit there. It has some use in jewelry or whatever, but it really doesn't do a whole lot. You know, if you own a share of Apple, I mean, Apple is going out and innovating. They're making new products. They're selling their products. They're constantly coming up with new ways to make things cheaper and improve their manufacturing. They're actively trying to create value for you as the owner, whereas gold or baseball cards or Bitcoin or any other asset that just literally sits around and does nothing from gold or Bitcoin is if somebody else in the future is willing to pay you more for that asset than you were paying for it today. Maybe that happens, maybe it doesn't, but there's no fundamental basis for how to value it, one, or number two, there's no way for it to do anything productive to create new value for itself. It's all based on speculation, and if inflation goes to 20, then yeah, gold's going to do pretty well, a lot better than stocks in that environment. But if inflation remains about where it has been or where the bond market is currently expecting it's going to be, there's a very high probability that stocks can continue to do decently well in that environment. I personally do not have any gold. I don't own any treasury bonds or treasury bills. I pretty much just own stocks, and that is because over the next 30 years, which is my time horizon, I think there's a very high probability that stocks not only beat inflation, but beat pretty much any other asset class. And based on the evidence, I feel pretty comfortable with that position. If you're worried about short-term inflation, you know, maybe you consider some sort of a hedge. But if you have a very long time horizon like I do, I don't think there's really a whole lot of evidence to support buying gold or commodities or anything else, any traditional inflation hedges. Anyways, that's just my opinion. So do your own research as always. But thank you for watching this video, and I will see you guys in the next one.